Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Cliff Corso, President and Chief Investment Officer with Advisors Asset Management. Cliff, it's great to see you again. Welcome back to Trade Talks.
It's great to see you again, Jill, and thanks for having me.
A regime change is now taking place in the market. What does the new one look like?
Well, the old one was one that lasted for almost 40 years. I started investing in the 80s, and I only saw lower and lower and lower bond yields, lower and lower inflation. So the playbook was well trodden over those decades, but that's changed now. The new regime is the mirror image of that. It's higher inflation, higher rates, fears over the Fed potentially going overboard and creating a recession. That's created a lot of volatility and uncertainty. We don't think this is just a short-term phenomenon. We think it's going to be with us not for quarters, but for years.
So do you think that the challenge of supply chains, rising housing costs, and wages will be a long-term issue for the Fed because they can control rates, but they can't necessarily control those individual outliers?
That's a critical point, Jill. The Fed has a very blunt toolkit. They can hit the demand side of it by raising rates and slowing the economy and creating demand destruction, but they can't increase supply, right? Higher rates are not going to necessarily increase supply. So they're in a tough spot. I think the structural parts around inflation, you hit a couple of them. Housing and wages, those are they're rising north of 5% a year. Those are well over 50% of CPI. And those are structural issues. Demand for labor is outstripping supply of labor. The demand for housing is outstripping the supply for housing. These things tend to be sticky, and they're going to be with us for a while.
So what are the investment implications while waiting for the correction to correct?
Sure. So we think rates continue to rise a little bit. We're not talking about 70s type interest rates because we think it's going to take a while for the Fed to actually get inflation under control. So we could see a test again of 3.25 on the 10-year, maybe up to 3.50. So as rates continue to rise, we've seen a lot of it occur already, but as rates continue to rise, the playbook should be underweight duration or sensitivity to higher interest rates, both in equities and bonds.
So where do you go in equities?
Sure. So in equities, we favor the more predictable sources of return. That would be steady income. As rates rise, it's a math problem. It's just math. As rates rise, those companies that don't have cash flow or earnings get discounted much harder than companies that have current earnings. So we think focusing on dividends and dividend growers and payers in quality companies and equities would be the way to go.
And what about fixed income?
Fixed income's been a little bit of a challenge. Jamie Dimon called the economy potentially facing a hurricane. The hurricane's already blown through the fixed income markets. Rates have doubled. The 2-year went from a few basis points to almost 3% in a nanosecond. The bond market's really kind of ripping the Band-Aid off. The Fed's only moved a couple of times, right, at this point. So within fixed income, still a challenge, but we're seeing finally some pockets of value. We would still underweight duration, i.e. the sensitivity to interest rates, shorter maturity. But with the 2-year pushing 3%, we still favor shorter maturity investment grade credit bonds. We're getting close to 4% now. So it's finally got a little bit of attractiveness to it and still defensive against higher rates.
All right, Cliff, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.